Hi, my name is Adam Schneider and I am with Oakwood Lending. We are a private hard money lending company based here in Raleigh, North Carolina. And in this video, I'm going to talk a little bit about my background in real estate investing, then talk about how Oakwood Lending got formed, how we evolved, how we underwrite, and hopefully we're someone you want to do business with, and hopefully this video will make you feel more comfortable with us and have a better understanding of what we do. So in 2012, I jumped into real estate full throttle. I got a real estate license and I joined Homevestors, the We Buy Ugly Houses people. We're professional discount home buyers. So CarMax is a discount car buying company. We're a discount home buying company. And that's where I got my feet wet. I've purchased about 150 homes as of right now. And that's where I learned all about real estate investing and flips and how to assess deals. And somewhere around 2014, we were having a neighborhood poker game and I met a guy named Tim and we started doing business together, and he is now my partner in the Oakwood Lending venture. So we started off by self-funding loans that we do to other people, and these are hard money loans. And so if you're not familiar with the term, a hard money loan is different than a conventional loan that you might get on a 30-year mortgage for a house that you're buying to live in. A hard money loan is based on the hard asset primarily. That means the house itself in this case, and not as much on the borrower credit worthiness as in a case of a bank loan with a mortgage on it, where it's heavy underwriting on the borrower's credit worthiness. So these loans are different. They're way more expensive than bank loans. They're short term. So the money works really hard for us and then it goes on vacation, and then it works hard and it goes on vacation. And the risk is different than with a bank loan on a 30-year mortgage because these properties all need work to be done to them. So because of the higher risk factor and because it's short-term usage and then it's on vacation, those two things mean that these loans deserve much higher rates than the bank loan. Okay, so we started off self-funding. Then as our business grew, we went to a bank and we collateralized some property and we used that. We borrow from the bank at a bank rate and then we lend it out at the hard money rate. So this really helped us to grow. Well, when we kept expanding past what the bank was willing to lend, then we did a 506 raise, that's an SEC term, and we reached out to people who are accredited investors. And an accredited investor has a specific definition, so you'll want to look it up to get the exact definition. But essentially, that's somebody with at least $1 million in net assets other than their primary residence, or somebody who earns or is predicted to earn at least $200,000 a year if they're an individual, or $300,000 a year if married. This is a definition as of now, June 2020. So we asked people who are investors if they were, or accredited investors, if they were interested in lending us money, and then we would re-lend it out. So we pay them at a rate where there's obviously a margin for us when we re-lend it out, and at a rate where obviously it makes sense for people to consider it as a way to diversify their portfolio if everything else makes them comfortable. So that's the backdrop on who we are and how we get going. And so the way Tim and I operate is that I do the business development and the underwriting. So I look for borrowers who need to do flips, as an example, and I'll underwrite it and run comps. And we operate in North Carolina. And then once it's underwritten, then I hand it over to Tim, and Tim services the loan. He deals with all the paperwork, deals with the attorneys. North Carolina is a state where attorneys do the closings, which isn't the case for all the states. So when we are doing these loans, the question is, how do we mitigate the risk? Because if you're someone who wants to do business with us, or if you're just watching the video and you're thinking about becoming a lender on your own, that's the critical part. How do you mitigate the risk? So quickly, these are the things we do. So the first thing we do is we only lend at a maximum of 70% of the value of the property. So for comparison, if someone does a VA loan, if there's a veteran, and they're buying a house with a VA loan, that's 100% loan to value. An FHA loan is 96.5% loan to value. Conventional loans might be 80 to 90% loan to value, and we're at 70% loan to value. So that's a critical piece about the equity and the cushion. We only do first position liens on it. These properties are secured by that collateral. It's done by a deed of trust. We have a promissory note, and that will describe all the terms and conditions, so there's no surprises on it. We require that there be insurance. The borrower pays for the insurance and names us as the mortgagee. There's title insurance. The borrower gets title insurance for themselves and pays for us, the lender, on it. And so if we underwrite these properly and we have a good sense of the value of the property, how much the repairs are, and we do all those things that I just covered, and we get the deed of trust, and we have the insurance and the title insurance, and we're doing these at a 70% loan to value, that's a huge spread, a good cushion on it. So if you're somebody who's interested in this and you're thinking about subscribing and you're wondering how that works, you can reach out to us and we can go into more detail on the whole program. So my name's Adam, and you can reach us at oakwoodlending.com. You can send me an email at adam@oakwoodlending.com. Thanks for listening.